How far will apartment rents fall this year? It's like, as you said in the notes, in the show notes, Matt, it's no longer a question of will rents grow or fall. It's now how much will they fall?
Yeah, that's kind of the world we're living in, and the atmosphere that we're swimming in. Even if the headline doesn't match the content of the article, and spoiler alert, it doesn't. None of the people cited here are citing negative, are going to expect negative growth. Despite that, it doesn't feel out of place to have a headline that says how, because that's what people are asking. You know, we've had so many months of negative growth. Well, how far are they going to go? You know, but given this atmosphere of negative expectations, it is nice that a lot of these experts are predicting, actually, you know, seems like a much more normal year of rent growth, one where it could be bad or it could be good. And that's, as shocking as that might seem, especially after 2021 and even really 2022, where rent growth was pretty elevated. You know, it may be dampened, but it's not wholly horrible.
No.
And it's just one of these things where you're going to have to work to find deals, just like you'd had to do maybe in 2017.
Yeah, you're really going to have to work. And also to note, I mean, these are all national like averages.
Yes.
Which is, I mean, you could have absolute, you know, horrible, you know, negative rent growth, you know, declining rents in one market, you could have positive in another, and maybe it averages out to zero. And so your takeaway would be incorrect to say, you know, we're going to have 0% rent growth you know, next year. It's always market by market specific, but then there are these larger national trends that we do see. I mean, like the slowing down of traffic and like signing of new leases. You know, that's been a kind of across the board a national story, but how that's translated to, you know, rent growth or rent declines has been very different relative to where you are, what's going on in your market, and a lot of it has to do with kind of what the supply and demand you know, landscape looks like. If you're in a market that's got thousands of new A-class units coming online, well, yeah, if you have an existing A-class property, it's going to be tough competition. But if there's like no new construction coming online, it might be a little bit of a different story.
Yeah, and I think that as some of the other articles in this that we're going to read this week bear out, it matters on the market level, but really kind of like on the sub-market level.
Yeah,
there's
100%.
some vastly different performance, and we'll see. We're going to use Cleveland as an example as we discuss it now, but like depending on which Cleveland you're looking at, it could be doing incredible, or it could be doing not quite so incredible.
But let's get into, so Matt, we've got some familiar names in this report that that Globe Street quoted. Greg Willett is one. What is Greg Willett? He's from Institutional Property Advisors. What's his
Greg
take?
Willett predicts, and this is his best case scenario, 3.1% rent growth. He says that we're going to see strongest rent growth in the middle of the road Class B properties, some in Class C, but there's going to be challenges in Class A as they compete for some of the newly built apartments that are coming up in many places. Again, apartment supply is going to be different in each and every market, and if you are investing in a Class A apartment in a market with little to no new supply coming online, there's going to be a lot less of these risks of poor performance. A lot of Greg Willett's follow-up commentary about, you know, the risks of the Class A sector is follows from this new supply coming online, whether they're kind of leasing up and giving concessions that might make your own property less attractive or whatever, but that's kind of where he finds it. And it's interesting, all the experts here. So Greg Willett talks about property types. The next expert we have is Jay Parsons, who talks about markets and submarkets, and I'll get into Jay Parsons here right now then. Like Willett, Parsons sees Class B as a promising asset class, but most specifically, suburban Class B. Parsons also sees some challenges for the Class A properties, just like Greg Willett. Specifically, though, he thinks the downtown is the one where things might get the shakiest. I'll be interested to see how the city and suburb trends play out because we're not going back to the central business district just yet, but we are going back. There is a trend there. And like, I'm wondering how much is remote work going to stick around. And another trend that this is a broader trend throughout the nation is millennials entering the generation where they kind of want to live in a home and start a family rather than live in an apartment.
And that's what I was going to ask, Matt, is, how much is it, people got scared during COVID, left downtown, but then they're going to come back because there's stuff to do downtown, or is it a really a longer trend of, hey, there's a big demographic group of millennials who are just moving out to the suburbs for more space permanently. They're not moving back to the city in the next few years. You have the Gen Z population that is moving into the urban cores, but a smaller demographic group than the millennials that they are replacing. So, on one hand, we're seeing recoveries of the downtown. Certainly aren't the complete ghost towns like they were during 2020, but are we going to see that growth, especially when it's lopsided with the fact that so many developers were so bullish on the urban core? The whole story and the theme of the downtown urban core and mixed use, was really driven by the growth of the millennial generation that we're a part of. Coming out of the great financial crisis, finally somehow able to get a job, and then wanting to live in more of an urban environment, to have that kind of life experience. Had that life experience, and some people are going to stay, but a lot, some by choice, some by necessity, need to move out to the suburbs. And so, the downtowns are going to come back, but is it going to be the same? And are we just going to see a glut of new apartments over the next couple of years? As developers were just, I think, playing from an old playbook. It wasn't old in 2012, but that they were kind of going over the same strategy, that millennial urban core CBD strategy that I think may have kind of moved away kind of while they weren't watching out to the suburbs.
I think that demographic shift is a little bit more of a powerful trend than remote working. Remote working, it's going to come and go. It is going to have an incredible effect on working culture. But when we're talking about getting an apartment and living somewhere, I'd like to think that people, it's that stage of life rather than, what working conditions. Because people are coming to the office, whether it's 2 days a week or 3 days a week, it probably, the interests that bring you down to the downtown versus the suburbs are gonna stay there, whether you're working 5 days a week or, 4 days a week.
I think it's more of what type of lifestyle are you looking for rather than just your commute time. I mean, commute time can be a part of it, but I think where you're going, and I agree, is that I think the work from home effects are going to be much more on the margins compared to a much larger trend of just millennials changing their behavior. Having kids, maybe they want a yard with a dog, and like you said last week, maybe this is if home buying attitudes really have changed fundamentally, maybe this is going to be a boon for the rental of single family homes. That was just exactly my thought as well. I think the BTR, build to rent concept is picking up more and more steam, and I think it makes just a ton of sense. For all of those reasons. It's still a relatively new asset class, and so there's still some questions out there of, what do they trade for? How do you manage them efficiently? But I think that's what a lot of smart and savvy investors are looking at. I mean, we're certainly looking at a handful of opportunities. I mean, you can't make it. It's almost like you can't put more pressure on millennials to hate home buying. They were hit so hard in 2008 and they almost quite recovered, and then they were hit again with either huge mortgage or huge home prices or kind of both. Now it's like, where do they go? When are they just going to say, listen, this is a world that I don't need to participate in. I don't need to get this mortgage. I can just rent. And maybe that's not a bad idea. I think that's going to continue to happen. The next expert comes from Yardi Matrix, and they have their prediction, which is a 3.1% rent growth prediction, is the same as Greg Willett's, but Willett's number was his best case scenario. So maybe Greg Willett, maybe
a realistic figure is 2.5% rent growth. But that's putting words in his mouth. We did cover the Yardi matrix.
Do you think, sorry, I'm not interrupting, Matt, but do you think that they were just like 3% because that's like the average over time? And I'm just curious I wonder how much like actual like data went into coming up with these numbers and how much it was like, it's going to be around probably 3%, and Yardi's is what, 3.1 to 3.5. So they're not like round numbers, but there's nothing preventing someone from adding a decimal just to make it
3.1 like
specific.
Does seem yes exactly.
It's like it's 3.1. But also it's like, you know, what when I think of this is, or how I'm thinking about it is, you know, we're probably not going to see. It's not like we're going to see 3% every month, or, you know, annualized 3% every month. 3 divided by 12. But, you know, so what is the first half of the year going to look like versus the second half?
So Greg Willett talked about asset types. Jay Parsons talked about markets and submarkets, or basically submarkets. And now Yardi Matrix is actually talking about timing. So you've got, you know, place, time, and type. It's a nice little, I don't know if they plan on this in Globe Street, but here is the timing that Yardi Matrix says. They expect lower growth through the spring that picks up in the summer of this year, but then kind of in late Q3 or Q4, they expect a mild recession to dampen rent growth, but not enough to wipe out all of the growth gains from the first part of the year. So it's a little bit of a roller coaster this year when it comes to rent growth. I think we're still reacting to the huge growth that we saw. We're still in this moderating cycle, and I'd like to see us claw our way out of it sooner rather than later.
But that, you know, the Yardi Matrix is maybe not their point, but, you know, that assumption of a recession, that's the big wild card. Of if first, I mean, we went from several weeks ago or a month ago, recession was an absolute certainty, and all the metrics, you know, put the probability at, you know, 99.9%, and then the last week or so, it's been, well, maybe that's not the case. Maybe we can engineer a soft landing. Maybe it's not going to be that bad. And, you know, it's much more, you know, up in the air. And because people are looking around and seeing, you know, we're going through some kind of economic period, whatever we want to call it. But if we're going to actually have a true, you know, recession that includes like losing jobs and, you know, much higher unemployment rate, that's going to feel different than it is right now. Because while things are a little uncertain and scary, and certainly some people are losing their jobs, especially in the tech sector, we're not seeing complete wide scale layoffs, and we still have an incredibly low unemployment rate. So I think it's tempering down some of the absolute fear from the majority of just the general population. Who, you know, well, like, things are uncertain. And it's interesting because consumer confidence is, you know, way down in the toilet. Everyone's like, yeah, there's going to be a recession. But then you look at like spending, like people are still spending money. So it's like, you know, yeah, we're all worried about it, but, you know, our pocketbooks are doing something a little bit different. And it's hard to get into that recession when people are still spending money. And you can just see Jay Powell up there being like, no. We need you to stop spending money so we can have a technical, you know, contraction in the economy.
It's not enough just to feel bad.
Exactly. And I mean, but that's what the Federal Reserve is mostly using psychology right now to try to get things to just tamper down. So it's just, you know, relatively lower growth, and they can normalize things, but the economy kind of, I think, has a mind of its own.
And I wonder how inflation typically behaves in the winter months. But we covered last week, it was the CPI showed negative price growth, not even slower price growth, but like negative price growth. And we're gonna see the effects of falling house prices in the CPI too. I mean, it's going to take a few months to show up, but we've got that to kind of look forward to.
Well, that and rents falling too. Eventually, if we don't knock over
so falling shelter prices basically are going to act as it's going to be great news for inflation. So I wonder how much the Fed wants to continue kind of follow through and seem like they're serious, but it doesn't seem like we're scratching the surface of this huge inflation force that's going to push up against
Well, because I think that's my thoughts exactly, because if we kind of know that, you know, we're going to see decline in, you know, shelter costs and CPI in the coming months, so we know that's going to happen. So like, to your point, what are the other forces, the other inflationary forces that will really bump inflation up
Yeah.
because we just had a negative month of CPI and inflation. So, not that, I mean, China is opening up, so that could be a driver potentially, in the global economy. I don't know if it's going to push, U.S. inflation up that much, but I think it's, if that anything, that's more of a path to normalization.
Yeah.
Then also just on the very global macro front, I mean, there was just a report out this week that China, not to get too far away from U.S. multifamily, but China actually experienced population decline.
Yeah. Saw that.
That's very deflationary from one of the world's largest growing economies. I think India and maybe has now surpassed them in total population. But that population decline, the lack of growth is very deflationary, and we talked about this last week. It's those forces of the inflationary forces, combating the deflationary forces, and there are still some inflationary forces that are longstanding, like the onshoring or the nearshoring. But yeah, I think there's a good case for not high levels of inflation over the next couple of years and more moderate maybe. Yeah.
Now, it could be the case, and this is what else I've heard, is that we're entering kind of a new paradigm, whereas in the past 20 years, it's just been low inflation. It hasn't really been a huge problem, especially after the post 2008. But now we may be a situation where instead of fighting like in this low stagnation, we're overactive and there's too much inflation, and that's the kind of and that's what we're fighting against, and that's what we're kind of trying to cure. It's going to take a real big shift in the collective psyche of everyone. I don't know, maybe the pandemic reset that, but the prevailing thought that we're still in a recession, I think part of it is that we were programmed since 2008 to think of this economy as a bad one. And it's like just so easy to fall in that mindset again. It's like, oh, here it is. It lasted so long. You didn't even kind of realize we were out of it.
It's so true that, that conditioning that the great financial crisis really did to, I think, a lot of people, especially, I think, folks, our age, that, they really were coming of age or whatever you want to call it during that time period of like the economy always sucks, it seems like. And, the stock market's always crashing. But when in reality, that's like the opposite is true. That on average, like the stock market goes up and on average, the economy grows over time. But people are very quick to say recession, doom and gloom, and I think there's a difference between that just defaulting to crisis. There's a difference between that and taking a conservative approach or being cautious.
Yes.
I think that there's two different things.
And kind of to return back to my comments then about the headline of the article, it may seem like falling rents or recession or doom and gloom is the only possibility, but none of the multifamily experts here are saying that rents will fall at all. And in each one, there's going to be brighter spots than others. That seems a whole lot like normal to me. There's some good, some bad. That's life.
Yeah, exactly.
Look, it's not going to be as easy as finding the asset type that Greg Wilt likes, the submarket that Jay Parsons likes, and the best timing from the Yardi Matrix report. It's not like that. You can't just plug it in. But then again, like, these are not all horrible expectations. This could be as close to historical norms as we get, and that just means that you can't predict the future perfectly. That there's going to be some risk, but then there's also going to be a way to plan around it.
It's like I would say a similar year that we've seen in the past of where we're going to see, they would say we're going to have around 3% rent growth, but some markets got more, some markets got less, and it comes much more to how you're going to operate the property. And we're talking about inflation, but it also relates to financing and interest rates, and the last decade of just operating off of essentially cheap and free money, and that era at least coming to a pause, if not coming to an end. Of I don't think we're going to see like much higher rates and probably lower rates, and I think we'll probably continue a slow walk back down to much lower rates over time. But I don't think we can assume the Fed funds rate is going to be zero in the near future. But it's going to be elevated. But maybe hanging out or between 4 and 5, is right within like the historic norms. So it's really kind of coming back to more normalcy
Mm-hmm.
than anything.
Yeah, it is crazy how, and a lot of these numbers, and in some of the reports that came across this week, they talk about, depending on where you're setting your numbers, what's history and what's just like an unusual moment in history changes a lot.
Yeah, that's true.